if you took just $50 a month, right? Basically the cost of skipping, I don't know, one takeout dinner for the family.
Yeah, it's one.
Right. And you started investing at the literal month your child was born.
Yeah.
They wouldn't just have like a nice little savings account when they retire.
No, not at all.
Thanks to the sheer unbroken mathematics of compounding, they would have over $2 million.
It's wild to think about.
It really is. Welcome to the Deep Dive. Today, we are taking a sledgehammer to the myth that generational wealth is some exclusive club, reserved for trust fund kids in tweed jackets.
Exactly. We're tearing that down.
We are unpacking the ultimate blueprint for generational financial security, and this is based entirely on a masterclass of a roadmap. It's Episode 7, Long-Term Wealth and Retirement Tools from the Greenbridge Inc. Wealth series. Okay, let's unpack this because we are not just going to tell you to, quote, save your money.
Right. That's the worst advice on its own.
It is. We're going to show you the exact math, the exact accounts, and the specific legal documents that turn pocket change into a multi-generational financial dynasty.
And the best part,
Yeah.
this is a fun educational roadmap that's designed for you and your entire family to execute together, starting like literally this morning.
I love that.
Yeah.
So where do we even begin with this?
Well, what's fascinating here is that when you strip away the Wall Street jargon, the entire concept of generational wealth distills down to a surprisingly grounding philosophy.
Okay, grounding in what way?
True wealth, at least according to the framework we are analyzing today, has absolutely nothing to do with timing the market or, gambling on a hunch.
Right, it's not a casino.
Exactly. It relies on a mathematical certainty, time, unwavering consistency, and having the right retirement toolbox.
The retirement toolbox. I like that phrasing.
Yeah, and building this lasting security requires equal attention to two massive pillars. First, what you do while you're alive, right? The mechanics of how you invest and grow your assets.
Makes sense.
And second, the often ignored reality of what you plan for when you are gone, which is the legal architecture of estate planning.
Yeah, which people hate talking about, but it's so critical. So we are going to build this house from the ground up today for you. We'll start with the foundation, where to actually put your money, because opening the right tax-advantaged accounts is like half the battle.
Oh, absolutely.
Then we'll look at the framing, right? What specific stocks and ETFs to put inside those accounts, and how to use automated engines like DRI to make your money work while you sleep.
That's the fun part.
It really is. And we'll even pull back the curtain on advanced leverage tools like LeoPS for those of you wanting to supercharge your exposure.
Which, spoiler alert, comes with its own major warnings.
Oh, massive warnings. We'll get to those. And finally, we'll put the roof on by transitioning into estate planning, down to a vital non-legal document called a letter of instruction that will save your loved ones from unimaginable administrative nightmares.
Yeah, that document is a lifesaver.
So before we can even think about what assets to buy, we have to talk about where those assets live. We need to construct the physical architecture of your wealth.
Think of it like this. You cannot plant the highest quality seeds in the world on a concrete sidewalk and expect an orchard.
Right. The soil matters.
Exactly. The accounts you select are the soil. They dictate the environment in which your wealth will either compound efficiently or be, severely dragged down by taxes.
The taxes will drag it down hard.
Oh, totally. The Greenbridge material is highly specific about outfitting your retirement toolbox with the right vehicles. And each one serves a distinct purpose with specific tax benefits and maximum contribution limits defined by the government.
Okay, so let's walk through that toolbox. First, you have the heavy hitters for personal retirement, the Roth IRA, and the traditional IRA.
The classics.
Right. I always like to think of the difference here as a choice of when you want to pay the toll on the highway.
Oh, that's a great analogy.
Yeah. So with traditional IRA, you get a tax break today. You lower your taxable income right now, but you pay taxes when you withdraw the money in retirement.
Right, at the end of the road.
Exactly. But the Roth IRA flips that. You pay the tax today on the seed, but the harvest, all that decades of growth, is completely tax-free when you pull it out.
Let's take that a step further, actually, because the mechanism behind the Roth IRA is, arguably one of the most powerful wealth-building tools legally available.
It really is a cheat code.
It is. So if you put $10,000 into a Roth IRA, and over 30 years it grows to, let's say, $100,000.
Okay.
That $90,000 of pure profit is never taxed. Not a single cent.
Wait, literally zero taxes on 90 grand?
Zero. It completely removes the anxiety of trying to predict what federal tax brackets will look like 3 decades from now. You have locked in your liability today.
That is massive.
Hmm.
Then we have the workplace accounts, right? The standard 401k or the 403b for public employees.
Right, depending on where you work.
Yeah. And the critical mechanism here is the employer match. If your company offers a 3% match and you aren't taking it, you are literally declining a 100% immediate risk-free return on your money.
It's free money.
Free money. No hedge fund in the world can guarantee a 100% return on day one.
No, definitely not.
And for the self-employed folks or small business owners tuning in, the text specifically points out the SEP IRA.
Yeah, that's a big one for freelancers.
Right, because it allows for massively higher contribution limits than a standard IRA, letting you shelter a significant portion of your income.
We also need to highlight the HSA, the health savings account.
Oh yeah, people sleep on the HSA.
They really do. The material includes this in the toolbox because it functions as the holy grail of tax advantages. It is triple tax advantaged.
Okay, break that down. Triple.
Yeah, so the money goes in tax-free, it grows tax-free, and as long as it's used for qualified medical expenses, it comes out tax-free. And if you pay for your current medical expenses out of pocket and just let the HSA stay invested for decades, it essentially acts as a supercharged retirement account.
Okay, so that is the adult side of the equation.
Yep.
But the real magic of generational wealth is that it doesn't start with adults.
No, it starts way earlier.
Exactly. The blueprint emphasizes getting the kids involved early. They point to custodial accounts, specifically the UTMA, the UGMA, and the 529 plan.
Right.
Now, the 529 is specifically for education expenses, growing tax-free for college or trade school. But the UTMA, the Uniform Transfers to Minors Act, that is where you really hand over the keys to the kingdom.
The mechanism of a UTMA is honestly brilliant. As a parent or guardian, you open the account and you control all the investment decisions.
You're the custodian.
Right, you are the custodian. But the money legally belongs to the child, the literal second it goes into the account.
See, irrevocable.
Exactly. Then depending on your state, when that child turns 18 or 21, the account transfers entirely to their control.
Which is terrifying, but also amazing.
Well, this is how you execute the philosophy that investing equals long-term growth. You are giving them a 2-decade head start on compound interest.
But getting that head start requires a very specific behavioral shift, right? The Greenbridge mantra here is set it and forget it.
Yes.
They argue that the absolute linchpin of long-term stability is automating your investments.
Because human beings are, frankly, terrible at predicting the future.
Oh, the worst.
And we are even worse at managing our own emotions when money is involved. Think about it. If you have to manually log into your brokerage account every 2 weeks to transfer money and buy shares, you are giving yourself dozens of opportunities every single year to talk yourself out of it.
Yeah, you see a scary headline on the news.
Right, or you notice the market is down that morning, and you'll just say, I'll just hold on to this cash for now. Automation bypasses your behavioral biases.
Right. It forces the discipline. But I do want to push back on this automation concept for a second, because we see this question constantly.
Zeroing on me.
You're telling me to automatically buy into the market every single month, blindly. What if we are at the absolute peak of a massive market bubble?
That's a common fear.
Yeah, I mean, if I automate, aren't I just mechanically forcing myself to buy at the top right before a crash?
It's a highly rational fear, but it misunderstands the mathematical defense mechanism built into automation, which is dollar cost averaging.
Okay, dollar cost averaging.
Yeah. When you automate a set amount, say $500 a month, you naturally buy fewer shares when the price is astronomically high, and you naturally buy more shares when the market crashes and the price is dirt cheap.
Ah, because the $500 stretches further.
Exactly. You don't have to time the crash. Your automated system inherently takes advantage of it. This is why the material emphatically states time is greater than timing.
Time over timing, I love that.
Because when you combine that automated consistency with the tax-sheltered accounts we just discussed, you unlock what the source identifies as triple compounding.
Okay, we need to do the math on triple compounding, because the source points to it as the literal engine of generational wealth. But we need to see under the hood.
Let's do it.
How does an ordinary person achieve triple compounding?
So let's visualize the mechanism. Compounding at its base level is earning interest on your initial principal.
Right.
But then in year 2, you earn interest on your principal plus the interest you earn in year 1. It's interest on interest.
The snowball.
Snowball. Now let's make it triple. Imagine you hold a stock in a tax-free account like a Roth IRA, and that stock pays a dividend.
Okay.
Layer 1, the core value of the stock appreciates over time. Layer 2, the company pays you cash dividends, which you immediately use to buy more of the stock, accelerating the growth.
So you own more shares.
Right. And layer 3, because this is all happening inside the Roth IRA, the government isn't taking a 15 or 20% cut of those dividends every single year.
Well,
You are compounding the money that would have otherwise gone to the IRS. Appreciation, reinvestment, and absolute tax efficiency.
that is how a $50 monthly deposit turns into millions. The tax shelter ensures the snowball doesn't melt as it rolls down the hill.
Precisely.
But, I know what some of you are thinking right now. You hear all this, Roth IRAs, UTMAs, triple compounding, and the reality of your monthly budget just hits you.
It can feel overwhelming.
Right? You have a mortgage, groceries are up, maybe you have student loans. The idea of building a dynasty feels kind of absurd when you just want to make it to Friday.
Yeah, that's completely valid.
Is it actually worth doing this if you can only scrape together 20 bucks a week?
The text counters that exact psychological block with, honestly, one of the most vital sentences in the entire blueprint. Quote, "Your future self will thank you for every small deposit you make today."
That's powerful.
It's a profound reframing of how we view our money. You have to stop viewing investing as an expense. You are not losing $20 today. You are transferring purchasing power across time to the older, perhaps more tired version of yourself. Because of the exponential curve of compound interest, the money you invest in your 20s or 30s is exponentially more powerful than the money you invest in your 50s.
It's the timeline, not the amount.
Exactly. The initial magnitude doesn't matter nearly as much as the timeline.
Okay, so we have the accounts open, we've got the automation turned on, the soil is ready.
Yes.
Now we have to talk about the seeds. What are we actually buying every 2 weeks?
This is where we get specific.
Right. So the Greenbridge material provides a very specific breakdown. They split their strategy into two distinct categories, dividend and ETFs, and growth and long-term holds.
Two different buckets.
Yeah. Now, the source lists about 24 ticker symbols, but reading an alphabet soup of acronyms on a deep dive isn't going to help anyone.
No.
So let's extract the strategy behind these lists.
Good.
Let's look at the first category. They recommend exchange-traded funds, or EPFs, specifically pointing to broad market trackers like VOO, which follows the S&P 500, or VTI, which captures the total stock market. Why are ETFs the bedrock here?
Because an ETF fundamentally solves the problem of risk concentration.
Okay, how so?
If you buy stock in a single company and their CEO makes a disastrous decision or their product becomes obsolete, your wealth is destroyed.
Right, all your eggs in one basket.
Exactly. But when you buy a share of VOO, you aren't buying one company. You are buying a tiny fractional sliver of the 500 largest, most profitable companies in the United States simultaneously.
And it's self-cleansing too, right? Like if a company in the S&P 500 starts failing, its market cap drops. And eventually the index just automatically kicks it out and replaces it with a new thriving company.
Precisely. You don't have to monitor which companies are succeeding. The index does it for you.
That's the set it and forget it mentality.
Right. And alongside those broad ETFs, the first category heavily emphasizes dividend-producing assets, like the ETF SCHD.
Dividends are key here.
They really are. The mechanism of a dividend is a company essentially saying, hey, we made so much profit this quarter, we don't need all of it to run the business, so we are going to distribute the excess directly to our shareholders in cash.
Which provides passive income along the journey.
Exactly.
Okay, so that first category is your bedrock. It's broad, it's relatively stable, and it pays you cash along the way.
Yeah.
Now, contrast that with the second category, the source outlines, the growth and long-term holds.
This is a very different vibe.
Totally different. This list is packed with aggressive, single-company tech titans. We are talking NVIDIA, Tesla, Amazon, Microsoft, Apple, Meta.
Heavy hitters.
Yeah. It also includes payment innovators like PayPal and even exposure to gold through GLD. What is the mechanical difference in holding these compared to the ETFs?
The fundamental difference is capital allocation. A company like NVIDIA or Amazon historically hasn't prioritized paying out massive cash dividends.
Right. Why give the cash away?
Exactly, because they believe that if they keep that cash internally and reinvest it into research, artificial intelligence, or expanding their logistics network, they can grow the actual value of the company at a staggering rate.
So you're betting on the company's future value.
Right. You buy these growth stocks not for the quarterly cash payout, but with the expectation that the share price itself will be exponentially higher a decade from now due to relentless innovation.
Okay, so you have two buckets. The ETF bucket is your slow, steady, income-producing foundation. The growth bucket is your aggressive engine. But here's where it gets really interesting.
Because this is the best part.
Because the source introduces a mechanism that takes those dividends from the first bucket and turns them into an automated wealth-generating juggernaut. They call it DRIP.
The dividend reinvestment plan. This is the literal physical execution of the triple compounding we discussed earlier.
Let's break down the exact mechanics of DOP. The source defines it perfectly. Quote, "It is the program that allows investors to use the cash divs from a company to buy additional shares or fractional shares in that company automatically."
It's so elegant.
It is. So imagine you own 100 shares of a stock trading at $50, and they declare a quarterly dividend of 50 cents per share. On the payment date, the company deposits $50 of cash into your brokerage account.
Right.
If you don't have GOP turned on, that $50 just sits there as idle cash, doing nothing, earning nothing, until you physically log in and decide to buy something.
And idle capital is the enemy of generational wealth. What DOP does is intercept that $50 cash payment the millisecond it hits your account and immediately executes a market order to buy one additional $50 share of that exact same stock.
Boom. Instant reinvestment.
Exactly. No transaction fees, no logging in, no human intervention. You now own 101 shares.
And the absolute genius of the modern brokerage system is the fractional share.
Yes.
What if the stock price was $200, but your dividend was only $50? In the old days, you were out of luck. You couldn't buy a quarter of a share. But now, DREP will take your $50 and automatically buy you 1/4 of a share.
Which is mathematically vital, because 3 months later, when the next dividend is paid, you aren't getting paid on your original 100 shares.
Right, you have more now.
You are getting paid on a 100 shares plus that new fractional quarter share. Every single quarter, the base upon which your interest is calculated grows larger.
The snowball.
The snowball. Over a 30-year timeline, a stock with a strong DREP engine will often vastly outperform a stock that simply appreciates in price because the DREP investor is constantly acquiring more shares without spending another dime of their own paycheck. It is the snowball rolling down the hill, gathering mass at an accelerating rate.
It is arguably the most satisfying thing to look at in a portfolio, seeing your share count tick up every few months for free.
Oh, absolutely.
Now, everything we've talked about so far, right? The ETFs, DRP, dollar cost averaging, this is the foundational, safe, set it and forget it methodology.
Bit of bread and butter.
But the Greenbridge material doesn't stop there. They pivot into the realm of advanced leverage for listeners who want to amplify their returns and, importantly, who understand the risks.
Yes, major emphasis on understanding the risks.
Definitely. They explicitly advise that when you open your brokerage accounts, you should, quote, apply for options trading so you are able to buy LPs in your long-term accounts.
We need to tread very carefully here, as does the source material. We are moving from owning the underlying asset to trading derivative contracts based on those assets.
Right. So let's demystify LEPS. It stands for Long-Term Equity Anticipation Securities. The text defines them clearly as options contracts with expiration dates ranging from 1 to 3 years in the future.
Right.
To understand a LEAP, we have to briefly understand a standard option. An options contract gives you the right, but not the obligation, to buy 100 shares of a stock at a specific price, which is called the strike price, before a specific date.
Correct. But standard options are notoriously dangerous for retail investors because they often expire in a week or a month.
They're super fast.
Yeah, they are highly volatile, short-term speculation. LEAPs change the paradigm by stretching the timeline out 12 to 36 months. By doing this, they allow you to gain long-term, leveraged exposure to a stock's upward movement for a fraction of the cost of buying 100 shares outright.
So just to illustrate, if I want to control 100 shares of a $200 stock, buying the shares outright would cost me $20,000.
A lot of capital.
Yeah. But buying a LEPS contract that gives me the right to buy those shares might only cost me $3,000 in premium. That is the leverage. But wait, I've dabbled in options before, and the thing that always eats you alive is time decay. If the stock just trades flat for a month, your option loses value every single day just because time is passing. How do LEPS get around that?
Okay, so what you are referring to is known in options terminology as theta.
Theta.
Theta is the daily decay of an option's extrinsic value. Think of an options contract like an ice cube resting on a warm counter.
Okay, I'm visualizing it.
The physical melting of that ice is theta. The less time there is until expiration, the faster it melts because there is less time for the stock to make a dramatic, profitable move.
Right.
With short-term options, that ice cube is basically under a heat lamp. The theta decay is aggressive.
But because leap years have an expiration date 1 to 3 years in the future.
Exactly. You have effectively placed the ice cube in the freezer.
Ah, I see.
The source specifically points out this technical advantage, noting that leap ES offer, quote, lower time decay, or theta. The contract still slowly loses value over time if the stock doesn't move, but the rate of decay is incredibly slow in the first year or two. You are buying yourself the luxury of time for your investment thesis to actually play out in the market.
So I get to control 100 shares for a fraction of the cost, and the time decay is drastically reduced. It sounds like a cheat code.
Well,
What is the catch? Because there's always a catch.
the catch is total capital destruction.
Oh,
Yeah, and the text provides a stark, necessary warning about this. While Leap Yes offer immense leverage, they carry, quote, the added risk of total loss if the position is incorrect.
total loss.
Total loss. Let's look at the mechanics of failure here. If you buy $20,000 worth of shares in a solid ETF and the market has a terrible year and drops 20%, your portfolio is now worth $16,000.
It hurts, but you still own the shares.
Right. You hold them, you collect the dividends via DIP, and wait for the multi-year recovery.
But if you put that same money into a leaps contract,
If you spend $3,000 on a LEAPS contract and the expiration date arrives and the stock price has not surpassed your agreed upon strike price, the contract expires completely worthless.
worth zero.
It ceases to exist. Your $3,000 doesn't drop by 20%, it drops by 100%. It goes to zero. You have no shares, no dividends, and no capital.
Which is why the material specifies that leaps should only be used for, quote, long-term bullish bets, meaning you have deep conviction the stock will rise significantly, or for hedging against downside risk, creating capital-efficient stock substitute positions.
Yes.
It is a tool, like a chainsaw. It can cut down a tree 100 times faster than a handsaw, but if you don't know the safety mechanisms, you are going to lose a limb.
That's a perfect analogy, and because it requires such deep respect and understanding, the Greenbridge blueprint doesn't leave you guessing. They detail the required research methodology. Before you place a leveraged bet, you must visualize the risk.
How do you do that?
They recommend a specific tool, the options profit calculator. Because options are non-linear derivatives, their profitability isn't a straight line.
Right.
This calculator maps the Greeks, the theta we discussed, the delta, and shows you a visual heat map. It tells you exactly how much money you will make or lose on any given day in the future at any given stock price.
They also recommend the stock analysis platform to get a clear view of the company's forecast and financials. Because, before you buy a 2-year LP on a growth tech stock, you need to look at their balance sheet.
Absolutely.
Do they have massive debt? Are their revenues actually growing? And as a final research safety net, the text reminds us, quote, your brokerage also gives in-depth details on stocks and also gives insight on whether it's a good buy and long-term hold. Fidelity, Schwab, Vanguard, they have armies of analysts publishing free reports for you. You do not have to fly blind.
So the accumulation phase we have just covered, right? The tax-advantaged accounts, the index funds, the DR cheap automation, and the leveraged LPS. This is how you build the fortune.
Yes, the offensive strategy.
Exactly. But the source makes a very hard, very serious pivot right here. We are transitioning from the accumulation of wealth to the preservation of wealth.
The defense.
Because the sobering reality is that every single thing we just discussed is completely meaningless if you do not legally ensure it goes exactly where you want it to go when you die.
We are talking about estate planning.
Mm-hmm.
And I know a lot of people just mentally checked out.
It's so common.
You hear estate planning and you think, I'm 35, I rent an apartment, and I have a modest 401k. I don't have a sprawling estate. I don't need this.
The material shatters that myth instantly. It declares an absolute rule. Quote, regardless of your income, estate planning is a vital part of your financial plan. Everyone should do and solidify estate planning. Doesn't matter what your net worth is.
Because, if we connect this to the bigger picture, estate planning is not just about distributing millions of dollars. As the text explains, it provides greater control, privacy, and security of your legacy. It is about protecting your family from the agonizing, expensive bureaucracy of the legal system during the absolute worst week of their lives.
To really understand why this is necessary, we have to look at the mechanics of what happens when you don't have a plan.
Okay, let's walk through it.
Let's invent a hypothetical family, the Millers. John and Sarah Miller in their 40s, 2 kids. John gets into a severe car accident and is in a coma.
Okay, awful scenario.
Awful. He is the primary breadwinner, and his name is on the mortgage and the brokerage accounts. Without an estate plan, Sarah cannot simply call the bank and access John's individual accounts to pay the mortgage.
Because her name isn't on them.
Right. The bank will freeze the accounts. Sarah would literally have to hire a lawyer, go to a judge, and petition for conservatorship just to access her own family's money while her husband is on life support.
That is a nightmare scenario. And that is exactly why the source outlines the core 4 documents. Think of these as the 4 load-bearing pillars of your family's future house. Pillar 1 solves the Miller family's exact problem, the power of attorney. The text specifies this is somebody to make financial decisions. You sign this document while you are healthy, legally granting someone you trust the immediate authority to pay your bills, manage your investments, and sign legal documents if you are incapacitated.
Then Pillar 2 is the healthcare proxy. The text notes, this is somebody to make medical decisions.
So very similar to the financial one.
Very similar, yes, but ring-fenced entirely around your physical health. If John Miller cannot speak to the surgeons, the hospital needs a legally binding document stating that Sarah has the absolute authority to consent to or decline medical procedures on his behalf.
Pillar 3 takes the burden of the hardest medical decisions off your family's shoulders, the living will.
This one is tough.
It is. The source frames this as documenting what are your end-of-life wishes. If there is 0 chance of recovery, do you want to be kept on a ventilator indefinitely? You make that agonizing choice now in a legally binding document so your spouse or your children don't have to live with the guilt of making it later.
And finally, Pillar 4, the last will and testament, which dictates where your assets will go when you pass.
Right, the classic will.
Now, this is where the legal mechanics get incredibly nuanced. The text introduces a specific section titled Trust versus Will and why both are needed, explicitly stating you should learn how to create a trust to own all assets.
Which confuses a lot of people.
Totally. Because if I have a will that says, give my house and my brokerage account to my kids, why on earth do I need a trust?
We have to talk about probate. Probate is the legal, court-supervised process of validating a will.
It's a headache.
It's a massive headache.
Right.
When you die with just a will, your assets don't magically transfer to your kids. The executor of the will has to file it with the county probate court. A judge has to review it. Creditors have months to make claims against the estate.
And it's public.
Yes, the entire process is completely public. Anyone can look up the value of your estate, and it can take anywhere from 9 months to 2 years. And the court fees and lawyer fees can eat up 3 to 8% of the entire value of the estate.
That is the friction that destroys generational wealth. A trust is the legal mechanism designed specifically to bypass that friction.
Okay, how does it do that?
When you create a revocable living trust, you are creating a fictitious legal entity, almost like a mini corporation. While you are alive, you are the trustee. You have total control over it. But here is the crucial mechanical step the source implies when it says own all assets. You have to actually fund the trust.
Right. You can't just print the document and put it in a drawer.
No.
You have to physically go to the county clerk's office and file a new deed that transfers ownership of your house from John Miller to the John Miller Revocable Trust. You have to contact your brokerage and change the owner of the account to the trust.
And the beauty of that mechanism is this. When John Miller dies, the trust does not die.
Oh, because it's a separate entity.
Exactly. The trust still owns the house. The trust still owns the brokerage account. Because the owner of the assets didn't die, there is absolutely nothing for the probate court to oversee.
It bypasses court entirely.
The assets pass instantly, privately, and without court fees to the beneficiaries named in the trust document. The will simply acts as a pour-over safety net to catch any small assets you forgot to retitle, and to name legal guardians for your minor children, which, importantly, a trust cannot do. They work in tandem.
And as a final layer of the legal shield, the material forcefully underscores life insurance and the importance. We just talked about transferring massive illiquid assets like houses or complex stock portfolios.
Right, things you can't just spend.
Exactly. If you pass away unexpectedly, Your family might need cash immediately for funeral expenses, the mortgage, or just to survive the sudden loss of your income. Life insurance provides a massive, immediate, tax-free injection of liquid cash. It ensures your family is never forced to fire sale the incredible investment portfolio we just spent the first half of this deep dive building.
So we have the legalities locked down. We have the trusts, the wills, the insurance policies. But the Greenbridge Blueprint recognizes a deeply profound, often overlooked reality of death in the modern world.
What's that?
Legal documents handle the assets and the law, but they do absolutely nothing to handle the day-to-day administrative chaos of a grieving family trying to dismantle a digital and physical life.
Oh, wow, yeah. You can have the most ironclad revocable trust in the state, but if your spouse doesn't know the passcode to your iPhone to get past the two-factor authentication for the bank, or doesn't know where the key to the safe deposit box is, they're still going to be completely paralyzed.
The material forces you to confront this reality with a series of intensely practical questions. Quote, if something were to happen to you today, would your loved ones know what to do? Would they know who to contact? Would they know how to track down your assets? Could they recognize a legitimate creditor?
For 99% of people, the answer is a terrifying no.
Exactly.
The solution provided here is a document called the Letter of Instruction. Now, I want to be very clear about the mechanism of this document because the text is explicit. Quote, although this letter is not legally binding, it can make administering an estate much easier and more efficient for grieving family members.
It's the practical guide.
Right. I like to think of this as the master user manual for your life. The will handles the legal transfer of the physical house, but the letter of instruction tells your spouse which key opens the stubborn back door, what day the recycling gets picked up, and how to turn off the water main.
And the fact that it is not legally binding is, honestly, its superpower. The source notes, this letter can also be changed over time as personal information and circumstances change without the need to contact an attorney.
Which is huge.
Yeah, you do not want to go back to your estate lawyer and pay $500 to amend a legal document every single time you change your Netflix password or switch utility companies.
No way.
The letter of instruction just lives on your laptop and you update it as life happens. The only caveat the text provides is that it should not contradict any information in estate planning documents. It is a supplement, a roadmap to the legal framework.
The checklist the source provides for this letter is incredibly thorough. First, funeral arrangements. Do you want to be cremated? Buried? Do you want a big service or something private? Write it down so your kids aren't fighting over what they think you wanted.
It happens so often.
It does. Then, important documents. Where are the birth certificates, the marriage licenses, the actual trust documents? Financial representatives' contact information. Give them the name, phone number, and email of your CPA and your broker.
It continues into the digital realm, which is where most estates become a true nightmare.
Oh, the digital life.
Asset info, online accounts, phone and computer files, and crucially, passwords. Without a master password list, digital assets can literally be lost forever. Then, dead info. If a random collection agency called your grieving spouse demanding $5,000, they need the letter of instruction to verify if that is a legitimate creditor or just a scammer preying on widows.
Beneficiary info is on the list, which we will drill into in a second. Personal property distribution, who gets the grandfather clock, who gets the photo albums. But the item on this list that hits hardest for me is pets.
Oh, yeah.
It seems so trivial compared to $1 million trust fund. But for a family in the depths of mourning, figuring out the specific care instructions, the vet's contact information, and the feeding schedule for a beloved dog or cat is an immediate, highly emotional need.
It really underscores the profound humanity of this blueprint. And the final item on the checklist is personal messages and explanation of your intentions. This is where you explain the why.
The reasoning behind the will.
Exactly. If you left more money to a child with special needs, or if you donated a portion of the estate to charity, write down the love and the reasoning behind that decision here. It removes the mystery, the resentment, and the potential for family conflict.
Now, earlier in that list, we mentioned beneficiary info. The source carves out a massive warning section specifically for choosing a beneficiary, because this is the precise intersection where the financial accounts we opened in segment 1 collide with the estate planning we are doing now.
This is critical. A beneficiary is simply a person or entity you name to receive a specific asset upon your death. And you designate them by filling out a form directly with the institution holding the asset, so the bank, the brokerage firm, the life insurance company.
And here is the mechanical reality that catches so many people off guard. The source states these designations should align with your overall estate planning goals and objectives. Why? Because beneficiary designation forms legally override your will.
I cannot emphasize this enough.
Let me say that again. They override the will. If you drafted a beautiful new will yesterday that says, all my worldly possessions go to my current spouse, but your old 401k from 15 years ago still lists your ex-spouse on the beneficiary form,
Oh, man.
your ex-spouse is getting the 401k.
It is a devastating, entirely preventable tragedy that plays out in probate courts every single day. The custodian of the account is legally bound by contract law to hand the money to the person named on the form, period.
The will doesn't matter.
The will is irrelevant to that specific asset. That is why the material stresses auditing these forms, noting that you may name multiple primary beneficiaries, dividing the account by percentages, and crucially, you must name contingent beneficiaries.
The contingent beneficiary is the disaster backup plan.
Yes, the text explains this is necessary in case all the primary beneficiaries predecease you. It is a grim thought, but true generational planning requires accounting for worst-case scenarios, like a tragic accident involving your primary heirs.
Right.
The silver lining, as the source reassures us, is that updating or adding beneficiaries later is easy to do and can take just a few minutes. It is a 5-minute online form that secures decades of wealth.
We have covered a monumental amount of ground today. We've moved from the microscopic details of opening a custodial account and automating fractional share purchases through the leveraged mathematics of options trading, all the way down to the emotional depths of writing a password list for your surviving spouse.
It's a lot to process.
It is,
Huh.
but the Greenbridge source wraps this entire masterclass up with something incredibly proactive. They don't just want you to absorb this information, they demand action. They outline the Episode 7 Green Grit homework, framed as a comprehensive family activity.
It bridges the gap between theory and execution. Step 1 is the generational wealth activity. Have each family member set one long-term investing goal.
I love that.
It democratizes the concept of wealth. Instead of money being a taboo subject, you sit around the dinner table and you actually discuss the future. It gives children agency and an understanding of why that UTMA account exists.
Step 2. Research stocks to buy in your retirement accounts and refer to my favorite stocks list. Take those tickers we discussed, VOO for the broad market, SCHD for dividends, NVDA for growth. Pull up the stock analysis tool and look at the charts together. Understand what you are buying.
Get the kids looking at the charts.
Yeah. Step 3, acquire life insurance. Go get the quotes. Secure the protective liquidity shield. And Step 4, begin your estate planning process to protect your assets and relieve stress for your family. Call a lawyer, draft the Core 4, and open a blank document on your computer to start your letter of instruction.
It is the ultimate synthesis of the material. Grow the wealth relentlessly and protect the wealth flawlessly.
So what does this all mean? We started this deep dive talking about a $50 monthly deposit turning into $2 million. We mapped the accounts, we fired up the DRIP compounding engine, we explored the edge of EP, and we built a fortress of trusts and wills around it all. How do we internalize this blueprint?
I think it leads us to a profound perspective shift regarding our daily financial choices. If we connect this to the bigger picture, think about the letter of instruction and the deep emotional legacy planning we just discussed.
Yeah.
If you were forced to sit down tonight, right now, and write out your final intentions, detailing exactly what you are leaving behind for your family to survive on, how might that change the way you spend, save, and invest your money tomorrow morning?
Wow.
When you deeply understand the mechanics of the end, it brings terrifying, brilliant clarity to the beginning.
That is exactly it. When you know precisely what kind of fortress you want to leave behind, you pour the foundation today with so much more intention. Every $50 deposit matters. This has been an incredible deep dive into the true architecture of generational wealth. To everyone listening, thank you for joining us. Take that Green Grit homework, sit down with your family tonight, and start building your blueprint. Cheers to your green wealth journey.